Okay, tēnā koutou katoa. Thank you everyone for being here. So a bit like yesterday, this is a blended event. So blended in terms of in-person and online, but blended in terms of being a guest lecture for Think 304 and also being a CEF group webinar. So in terms of Think 304, I was going to sort of go through the simulation and show you what's relevant, how this lecture is relevant to what's happening or has happened in the simulation. And it's, but we're running a little bit late, so I'll just give a quick overview. It really is when you're looking at your business SME pricing and how much capital. So remember we did risk weighting, risk weightings and Basel I, and we're going to talk about Basel II and Basel III. And the context in New Zealand is that, you know, banks are being made to hold more and more capital for higher risk business loans. And this creates an opportunity for something called the private debt market, right? So when we think about debt, we generally think about bonds and we think about banks lending. But there's this exciting market that's been around for 20 or 30 years in Europe and elsewhere. But so Paul, our guest today, Paul Carman, is looking to develop that in New Zealand. It's a real pleasure to have Paul here. So Paul has amazing experience. He's a Kiwi, so from Wellington or studied in Wellington, and he worked for one of the largest Japanese banks, Mitsui, is it? How do I pronounce it? Mizuro, one of the largest banks, Japanese banks, and he helped develop their private debt business. He was their chief investment officer for that part of the business, and he worked in London, New York, Hong Kong, and Sydney, right? So across the important capital markets. So it's a real pleasure to have you here. What we'll do is we'll let him go through his slides and explain. It has three components. So he's going to talk about that risk and regulatory capital and how, you know, that might lead to the creation of this private debt market. And then he'll talk a little bit about sustainability and in those lending decisions. So welcome, Paul, and over to you.
Thanks, Ivan. Good morning, everybody. Thanks for the opportunity to spend some time with you today. Appreciate you've all got workloads that you're juggling, Ivan's been telling me. So good to have the chance to be on the other side of the desk. It's been a while since I've sat where you're all sitting, and really wanted to share with you a little bit of that last 35 plus years in terms of what we've been seeing and doing, and really share a little bit about, as Ivan's indicated, what's happening in the world of bank regulation, how that creates an opportunity for people like us, what we've done offshore with that, and really to talk about perhaps what's going to happen next in the New Zealand context, where we're playing a bit of catch up with the rest of the world. And then at the end of it, just talk a bit around ESG, some of the considerations for people like us, and also the people that we work for, being our investors. In terms of background, Ivan's covered it, so I'm not going to spend too much time. Suffice it to say, we've been pretty fortunate that we picked up an opportunity to work in a market which 30 years ago is very reminiscent, or was today, looking back, very reminiscent of the market we're seeing in front of us for New Zealand now. Most of our time had been involved in looking at the leveraged part of the market. For those of you who are doing all the Basel 1, 2, and 3 simulations and running your own banks on the software, we were looking at the spiky end of that market, the things that are really double B, single B, the areas where a lot of capital's allocated. And I'll talk about what the ramifications of that have been offshore and perhaps what that means for the local market. I'm not going to go through PCG. This is the business that we've set up in 2019, really on the back of the changes that the Reserve Bank in New Zealand had put in through their capital review of 2019. As you'll be aware, that's just started to be implemented, and we think there's some pretty significant long-term ramifications that'll change the Kiwi market in a very similar way to that we've seen in places like the US, UK, and Europe, and a bit more recently the Australian market. We are a New Zealand-oriented business. As Ivan said, whilst I've spent most of my adult life working overseas, Wellington is very much close to my heart. Having said which, pleasure to be down here in Dunedin and in Otago to talk a bit about where we are, what we're trying to do. But our focus is very much a New Zealand-oriented opportunity, and we're working with New Zealand businesses and New Zealand investors to try and create that private debt market. Enough of the background, enough of the plugging of our business, maybe talking about what's happened offshore. You'll be familiar with the Bank for International Settlements, set up in the 30s, really as a way of restoration after the First World War. That's provided a secretariat for a group of think tanks which really have spawned out of G10 and wider groups over time to look at associated areas, and one of those that's important is around the banking supervision. So the Basel Committee, which was set up in the mid-70s, was really set up by those central banks as a think tank rather than an entity which creates and enforces a policy. But because the central banks are part of that process, they typically take what comes out of BIS or the Banking Committee and implement that in their local markets. You'll be aware that one of the reasons that central banks want to regulate commercial banks is ultimately commercial banks are in no small part funded by retail depositors. We have a huge retail deposit market in this country, around $300 billion. It's almost as big as the money in the NZX. If one of the banks goes pop and retail depositors lose their hard-earned savings, needless to say, that causes a bit of indigestion and a bit of consternation. So government central banks typically act as a lender of last resort, which in practice means bailing out banks, which in practice means giving depositors back their cash. You might understand that governments aren't too keen on doing that. So the best way of controlling that is to put in place a series of policies and practices which are designed to really safeguard banks and the system from itself, and ensure that there is a copper bottoming to the system. And that process really started whilst the committee was formed in the 70s, it really started in earnest in the late 80s. I know you're all going through Basel I at the moment with Ivan, so I'm not here to talk about specifically what happens or to do any tests on any of that stuff, but really talk about the ramifications of what that's meant. And I think at a practical level, what we've seen happening is a series of ever more stringent controls. And there are three pillars to this regulation, trying to preserve capital by determining what minimum levels of capital should be for banks to operate, but also providing a supervisory regime where people are reporting, facing those regulators, and then really looking at the market discipline to making sure that there's continuity, consistency in all that's happening. So the context for all of this is really an increasing backdrop where bank regulation has increased. The latitude for banks to do pretty much what they were doing prior to regulation has reduced. And as a consequence of that, it shapes the activities of what the larger banks tend to do with their lending and how they apply their capital. In some numbers, on the right side, again, I think you're probably quite familiar with this, but the reality in concept is quite straightforward. More capital is required to be allocated to higher risk profile businesses. Were we to be in the States, were we to be in Europe, the ratings methodology is very developed. Most borrowers of a certain size have an external rating from an S&P and a Moody's. Australia, New Zealand, less so. And in NZ, the Reserve Bank basically has a framework around which banks report, which gives an equivalent rating. And what we see is a coefficient applied based off the credit rating of an underlying business. So simply put, whatever the minimum capital requirement is that the Reserve Bank in New Zealand will require at any point of time, you apply a coefficient against that. And if it's high quality, well rated, there's a coefficient of 20%, moves to 50% depending on the ratings category. Conversely, if you're doing a lot of what is perceived to be more risky business, there's a higher capital allocation up to 1.5 times. And as you might imagine, with banks acting rationally, banks are typically owned by shareholders. They're listed. Maybe in NZ, we've got 4 big banks owned by 4 big Australian banks, but those Aussie banks are listed. The banks act rationally. They're looking to maximize the return for their shareholders after all. And what that really has meant over the period that Basel I, Basel II, Basel III have tightened that regulatory requirement is banks have oriented more towards those parts of the rating category where lower capital is required. A number of reasons for that. It means they've got a finite amount of capital, so you can lend more if you apply a lower coefficient. But also banks make business not just from lending, on profit, not just from lending. They're making profits by the fees they charge, the clearing they do. And if they can make an income on that activity, the lower amount of capital they're applying to the borrowings that they provide, it means the numerator of that equation is inflated. They've got a smaller denominator, so hey presto, higher return on capital, happy shareholders, happy parent banks, and more capital for banks to deploy. Well, that does mean in practice, and the purpose of the graph on the left, which has a sort of a big peak in it around 2008, 2009, time of the GFC, is actually a demonstration that banks have rationally allocated that capital. If we take that risk spike out during the GFC, you can see that the line on yield has contracted pretty much from high left to low right, which really reflects the fact for investment grade risk, IG yields, investment grade yields, so categories 1 and 2 in the RBNZ rating methodology, you can argue category 3, there's just been a huge concentration of bank lending activity into that area, increase the supply, the relative supply, so that's pushed down the pricing that borrowers have to pay or the return that banks make on that. And that's not right or wrong, it's rational. Banks have allocated capital there, but a good demonstration of that activity or that movement is the compression in yields that we've seen. At the other end of the market, banks have been very loath to devote capital where it's expensive. And a good proxy for that is market jargon. We use the context of leverage loans to really describe things that are sub-investment grade. So double B and below, maybe triple B and below, depending on where you want to draw the line. And if we look at that graph in both Europe, well, look at Europe, maybe it's a bit more pronounced, given the US was into this journey earlier. You can see that around the turn of the century, sounds like a long time ago, turn of the century, doesn't it? But yeah, 20 years ago, the market was really flooded by banks. The market was flooded by banks. Banks lent, and clearly as they allocated capital to the more yieldy for them parts in terms of return on equity, it created a vacuum. The capital evaporated for banks deploying into leverage loans, and something needed to fill that gap because there are plenty of borrowers out there who want to grow. Companies which are low risk are easy for banks. Companies at high risk, more difficult, but not all high risk borrowers are necessarily bad risk. We've seen things like the buyout market where private equities come in to buy good quality businesses and leverage those companies that have got very stable cash flows. And that's been very attractive for people like us in offshore markets. Is what we did in our European business for a number of years, was to play as a private credit provider. In other words, to fill the gap that came from banks allocating capital to the better rated assets rather than the less well rated assets. That was not necessarily about good and bad business. Again, it was back to this theme of how much capital you've got to deploy if you are a bank. And we can see really in the European context how the grey boxes, the light blue boxes have just really, again, gone from high left to low right. And we've seen institutional investors, for which read private credit funds, fill that space. US started that journey probably about 6 or 7 years before Europe. You can see that it's followed a very similar line. Today, less than 10% of that leveraged loan market is provided by banks. 20, 30 years ago, it was all provided by banks. Just demonstrates what's actually been happening offshore. That talks to who provides the lending, talks about what's happened within the banks, but there's quite an important facet to this around where does capital come from? Banks gain their capital from retail deposits, they borrow from each other. If you're setting up a private credit business, and we can attest to this, you don't go to the local bank and ask them for a bunch of equity to be able to start creating a business. You have to go to institutional investors, pension funds, insurance funds, and the like. And there's quite a good symbiotic relationship between private credit firms looking to lend on a long-term basis and institutional investors, people like pension insurance companies. They have liabilities which are reasonably predictable. They'll know roughly each year what their claims are if it's an insurance company, broadly speaking. They'll know, broadly speaking, if they're a pension company, what they've got to pay out. And what we've been able to witness over this last 20, 30 years is this development of, as banks have been reliant on depositors to fund their activity, and as the regulatory environment is squeezed around banks, funds like ourselves and others who are more established in the offshore markets have been able to attract this long-term, quite sticky money in the terms of pension companies, insurance companies, investing in the funds that are created by private credit that then deploy into those assets. It provides a long-term liability to fix a long-term asset. So in terms of balancing assets and liabilities, it's quite a conducive model and one that's scaled. And you can see on the right-hand side, the data there stops at 2010. If we roll that through to 2022, there's about $1 trillion invested globally in private credit. Grown from a relatively small base, as you can imagine, when banks were dominating the landscape. There was no room for private credit. There was no need for private credit. But as that opportunity has come through, and as institutional investors have given managers like ourselves that capital, we've seen a very steady growth to what's a relatively sizable number today. So it gives you a bit of context about the global picture. We're here in NZ, at least most of us are. I know we've got some people on the line from offshore. What have we witnessed in New Zealand? What's different in New Zealand? Why have we been a bit slow to the party? Arguably slow to the party. We've got a different landscape in New Zealand. We don't have a highly fragmented or diversified series of banks. If we were to jump into London, 30 banks in the square mile, as they refer to it there. In NZ, we've got 4 dominant banks. They've got 80% of the market. So it's a very concentrated market, and in an environment where we've had, actually, in a global context, a lot of growth, a lot of stability. Demographics have been favorable. We've had a rising population. That's created a lot of GDP growth. The GFC for the country wasn't as pronounced as it was elsewhere. And that's meant banks have had plenty of capital. You might argue, well, why is there a need for this capital reform? And one of the issues around the ownership of those 4 large New Zealand banks by 4 large Australian banks is each year capital gets dividended out from the Kiwi banks to the Aussie parents. And the buffer for a rainy day in the context of New Zealand banks having those reserves to cover anything unforeseen, whether it's COVID, whether it's another event, is compromised. The money's up with the parents in Australia. It's going to be very difficult to get that money back down. So the Reserve Bank has, since 2018, started a process of really looking to change that activity. That's something which was set in 2019 and is referred to as the Capital Review. And simply what it does in its most acute form is it moves the volume of capital banks are required to keep onshore from one figure to another. And that creates quite a significant differential. You'll be aware of what that is, but I'll show it on the next couple of slides. And we think this will provide the catalyst for a change in the way banks allocate capital from an environment of comparatively favorable economics, comparatively moderate regulation, to something which is a lot more acute and requires the banks onshore to perhaps follow what's happened offshore and creates this opportunity for private credit to develop. If we look back over the last 4 or 5 years, on the left-hand side, what we're trying to show here is that there's been a consistent growth in the underlying market. Banks have continued to lend. Yes, you can look at the yellow line, the percentage growth in the markets, and unsurprisingly through COVID, got pretty close to zero, didn't quite get there. Banks continued to lend. But if you start looking at different parts of the bank's balance sheet, in other words, where were they lending, and strip out, for instance, business loans, the areas that private credit is typically looking for. Private credit's not necessarily looking for providing mortgages and looking after retail requirements, although parts of the market do that. It's much more a business lending environment. And we can see there that in the middle slide, aggregate business lending actually went quite heavily negative during that COVID period. And in fact, the lending today, 2022, is roughly the same figure that it was in 2019 going into the crisis. Reflects the fact there was quite a sharp reduction, and that's come back over the last 6 months. But if we look at the big four, it's been a bit more pronounced. In other words, with capital review coming, which is not, the capital review implements across all banks operating in NZ, but the big four, for reasons I'll come on to in a moment, have an additional capital requirement over and above the wider market. And that's starting to shape the way the banks are allocating this capital. And you might see that in perhaps the recovery of business loans. If you look at the middle graph and the right graph, you can see the market recovered in 2021 across all lending in the country, 6%. For the big four, it came back 4%. Those banks have 80% of the market. So it tells you that something's going on there in the way that the banks are allocating that capital. I've just got a chart here to show you some of the numbers. I'm not going to go through this, but it just gives you an idea of the concentration within that market. I think people are pretty well versed in the relative share of the big four being about 80%. But just to give you a framework of who else is in there, if we look at all onshore banks, it's about 90% of the market. If we look at that in the context of business lending, that is. If we were to look at that in offshore markets, New York, London, for instance, that number would be a lot smaller. So the impact of capital review on the banking system, on the ability for people to lend, for people to borrow, we think is going to be a lot more pronounced in NZ, notwithstanding the fact that it's been pronounced offshore from the prior graphs. A little bit about what the change is. I know you're well versed in this, but the movement is broadly 10.5% of capital requirement pre the capital review to broadly 18%. The big four are termed by our regulator as domestically significant institutions, DSIBs on the right graph. And because those banks are systemically important, they have a high relative share. There's an additional capital requirement they have. The argument being, if they were to tip up, that has a disproportionate impact in terms of the wider market. I'm not going to go into the relative definitions of Set 1 and the other requirements. On the right-hand graph, we're just looking at Set 1, but we can use that as a proxy for the total Tier 1, Tier 2 capital requirements of the banks. We can see there's a huge differential. So 10.5% to 18%, significant. You apply the coefficients that we showed off the prior pages, 20%, 50%, 100%, 150%. You've roughly got a 7.5 times differential of the capital if you're providing a AA loan to a single B loan. That relativity hasn't changed, but if you're applying that off a 10.5% baseline or an 18% baseline, you can see that the actual capital requirement the banks are required to put in to support certain parts of their activity has really become quite significant. And we can see how capital review is likely to play out on the right-hand line. This is out of the RBNZ's financial stability report. They're projecting out the stability in the financial system. And the kind of comments that we're hearing at the moment is bank capital has never been higher. And if we look at the line today, we can argue that that's pretty much the case. Having said which, the baseline requirement, the dark grey boxes, shows a step up. And this is the step up of the phasing of the capital review. The RBNZ, in discussing this with the commercial banks, provided a phased approach to implementing the capital review rather than going from 10.5% on one day to 18 the next day. I think it's quite reasonable. Having said which, we can see that the RBNZ's extrapolated line, the dark blue line, starts to get pretty close to intersecting the minimum capital requirement in 2028. The red line's the actual performance, and we can see there's a bit of a drop down. The drop down reflects the fact that for domestically significant banks, they're able to allocate capital based off the bank's own risk model. So there are two formats in which you allocate capital. One is if you're significant and large, you can use your own internal rating methodology. And if you're not so large and therefore not afforded a domestically significant, or for that matter, a regionally or globally significant status, you have to use a standardized approach. And there's a gap between the two. And as part of Basel 3 and 4, there's a requirement for banks to reduce the gap between those two. And we're seeing the first signs of that happening now. It happens this year. You can see the pickup, if you like, in the line on the blue line, reflecting that fact, and you can see the red line is banks actually getting ahead of the game to do that. So capital requirements are going to increase. We know that. We can see that from the RBNZ's own financial stability reporting, there's going to be an intersection of those lines, and that's all predicated off a benign credit environment. These projections from the RBNZ assume a NPL, non-performing loan ratio, of around 0.5%. We might argue that at the peak of a cycle, it could be more like 3%. We've certainly seen figures around 2.5% common in NZ. So all that will do is shift that blue line down when it turns red, and we have the actual performance. So we've got banks required to make changes, starting to make those changes, and we think ultimately that predicates a shift into this move around private credit, which we and a few other people in the market are some of the early adopters to do domestically. So it's a bit of a canter through the big picture on what's got us to this point. What are the peculiarities in NZ? I did want to move the debate a little bit to ESG. If the capital review is a very much New Zealand-centric phenomena, which is really requiring banks to do what's happened offshore, it's a well-trodden path. But more globally, we're seeing requirements around ESG become central for borrowers, central for investors, but also central for managers like ourselves. This is not a lesson on what ESG is. I know you're covering that. Okay, in which case, okay. So ESG simply is an increased awareness of what are the environmental aspects of one's business, what are the social impacts, and what are the governance aspects. And whether that applies for a company, a university, a fund like ours, or for the way people invest, there's a greater cognizance that in a world of climate awareness, increased compliance, the E and the G, and impact and social cohesiveness, the S, how do people in our shoes allocate capital? Is it about getting the highest return? Well, we've got a fiduciary duty to make sure we maximize returns as much as we can without taking undue risk. But there are many considerations that people have over and above just the financial return these days. And we might wrap that up in this context of ESG. We're at the, in many ways, start of that cognizance. And there are a number of regulatory, government, regional activities that try and prescribe best practice. I think at the moment, what we're seeing is people in our shoes grappling with how might you do that? There's quite a big focus around the E, the carbon, if you like, the sustainability, and a lot of the focus has been on that. People signing up to being carbon zero by 2050, for instance. It's 27 years from now. It's a long way off. It's good aspiration. NZ's enacted specific legislation on this, how to require operators with a certain amount of assets under management to do the right things. But what are those right things? And I think we're at the formation of this. I know there's going to be a webinar in about a month's time that Seb's doing around the pitfalls, perhaps, of managers, investors, ESG policies and practices. I think he's referring it to as green lemons. The risk of greenwashing, saying that you're going to do these wonderful things and deployment doesn't really fit with the story. So I think at a macro level, a lot of good intent, a lot of people scratching their heads to work out actually how do we create our policies and practices and what's the right way to do that. I haven't got a blueprint for it, but there's a cognizance, and I think there are groups like ourselves who are trying to share and create a best practice. But this is a starting point in the journey, not an end point. Something where I think over the foreseeable future, it's going to continue to be an ever increasing requirement to have coherent policies around this and to be able to explain those. A couple of areas just to touch upon in this is there's an analogy here perhaps with credit risk and with ESG risk. Ultimately, companies are borrowing on the basis of their credit standing. AAA, single B, banks, private credit. Doesn't mean that B is bad, doesn't mean that AAA is great, but it's an allocation of that risk. And I think we're going to start to see much more differential in terms of companies that are perceived to have a high ESG risk and those with a low ESG risk. So those that are operating in an industry which is clean, most likely banks are going to gravitate towards that. I think private credit will be interested to look at those assets. But those are companies that will have a low cost of capital through a combination of a very strong credit rating and a very strong ESG compliance. There'll be other businesses out there which don't. Does it make them bad? Well, they may be doing certain things that does make them bad, or they may not have policies in place which are showing a direction of travel. But I think there's a lot of business out there going through transformation, which may have very poor practices today, maybe more discernible in the context of carbon and the like, which are trying to improve. So one of the niches for people like us, people like private credit managers, is to deploy capital against those perceived higher ESG risks, not because it's more yieldy to do that, but it's providing capital to help companies to make that transformation. We've divided up on this illustrative chart ESG risks between higher and lower and split how private credit might work. Private credit for a specific project, a new solar farm, pretty identifiable. You can work out what needs to be measured, how it needs to be measured. You could argue that's a comparatively low ESG risk. But a corporate that's got 5, 10, 15 operating businesses, it's an extremely complicated task to work out how do you incorporate an ESG strategy for a business like that. Again, I'm not sure we've got answers to these questions yet, but they're the kind of issues that we're trying to think through. I think the market is too. Reflecting that fact, there will be pricing premiums for businesses that are required to access capital for that transformation. They'll need to pay more for them. We've got to be careful that for people like us, that doesn't just become an opportunity to augment yield. It's very easy to look at all the dirty ESG businesses and recognize that people aren't lending to them and therefore make a super profit, arguably, in doing that. I don't think that's where private credit's headed, definitely not where we're headed, but it reflects the fact there's a risk reward that will be reflected. And there's an analogy between credit, which is well established and understood, and ESG, which perhaps at the moment is less so. In terms of where are we? What are investors looking to do? what a manager's looking to do, it's complicated. I'm not going to go through each of those boxes, but on the left side, where are we at the moment? Like ourselves, I think people are forming their policies, refining their policies, having a cognizance. It doesn't mean that it's perfected. How to optimize that, how to work in concert with competitors, how to work in concert with with your clients. That's evolving. Best practice will come, but as I said, I think this is a bit of a journey rather than a destination. And on the right-hand side, it's really a template for how businesses might be evaluated. Quite difficult for companies to do everything at once, but there are things that they can do to show that direction of travel. And I think the market's going to require those easier gains to be actioned. And as it progressively moves into a deeper comprehension, time plays out, gives people time to move their ESG strategy for things that in theory sound easy, but in practice are quite difficult to implement. I think that's perhaps a template there for how we might perceive those tasks are tackled. From our own point of view, and before we get into a bit of Q&A, what are we trying to do? We're trying to do several things. One is that we've worked with a New Zealand-based group called Toitu. Toitu looks at various businesses, be they service like ourselves or manufacturing, primary, to look at the ways in which you operate and to audit your own footprint, primarily around the E as opposed to the S and the G. We're 2 years into that process. We've been audited twice. We can call ourselves carbon zero. That's in terms of what we do. It doesn't reach through to the lending we do yet. That's coming. And that's why policy requirements are quite important in terms of our practice. We scratched our heads to work out, where do you find best practice? Is it through others in the market? There's some great and good who have been doing fund management for a lot longer than we have, and we can speak to those. One of the areas where we actually think the academic world is a very interesting place for us to understand, and we've worked very closely with Ivan to weave Ivan and the team's expertise into our advisory committee, so that as we develop our ESG strategy, we're not doing that with just something reverse engineered from one of the great and the good in New York or London or somewhere else. We're trying to build that from the bottom up, understanding how that reach within academia is creating a best practice or a suggested best practice, and overlaying that with what we get from a bunch of the consultants and a bunch of the other operators in the market to define that best practice. I think in short, we're just trying to ensure we have a framework that is something that we can test, that can be consistent, and ultimately can be one that we can explain, that's logical. So yeah, I think one takeaway from the ESG side is you can well imagine it's not perfected, and it's a bit of a journey. And I'll stop there, cognizant of the time, but very happy to get into a bit of Q&A. If anybody's got some questions, please feel free.
Thank you, Paul. So we'll go to questions in the room first, and then we'll get online.
So my question is, what do you think about the statement from the BlackRock's former head of sustainable investing, Mr. Tariq Fancy, stated that ESG and sustainability investing are distraction. He also believed that ESG as a measurement standard has value, but using that ESG information alone as mechanism of changing is disastrous.
Good question. Oh,
thank you. We've got 10 minutes for Q&A. This could take about an hour and a half, I think. Therein is the issue, I think. You've got a lot of very large funds who manage hundreds of billions of dollars. What is people's edge? And one of the edges, one form of edge is your mousetrap, how you look at risk, credit risk fundamentally. But we've got a lot of institutional investors who have money from governments. Maybe a lot of people who've got money from millennials who maybe have a greater cognizance than when we were all growing up, not really fully comprehending the ramifications of some of the things that were being done. It's not an excuse, I think it's just a reality. And so I think it's understandable that people have a desire to ensure they're not doing things that are adding to the problem. How do you draw the line with not adding to the problem between being, virtuous and, the center of excellence for doing things that are additive? And I think this is the difficulty. A lot of people have said, well, ESG investing, we're making super returns from this, so it's even better to be investing in these assets than it is elsewhere. That might be true in terms of return for some of the reasons we just showed. But whether it's the right thing to be doing, in other words, is just economic return the right model? So when BlackRock, who, very hard to contradict the largest players in the market, and I don't think it's our intent to do that. I think there's a lot of truth in what that macro statement says. So I think what you really need to be doing is looking much more micro. What is it the investor's aspiration? What are we solving for? We look at the market and say there's an asset opportunity, but ultimately our capital comes from investors. So if you're out of sync with what your investors want, that's not a great way to sustain your own business. So I think there's a lot of truth in what's being said at a macro level. I think what it really boils down to is, what is it that activity you're trying to promote is doing in the eyes of investor requirements, through to moving away from some of the poorer practice. So yeah, look, I think what's my summary of the question? I think it's opaque, because I think it's really a function of what level are you looking at that. But to say ESG investing is a panacea to make perfect returns, I think is wrong. Having said which, the costs of non-compliance are only going to get higher and higher and higher for borrowers. And at some point, it's a cash flow issue, or it's a viability of the business issue. And if people like us or BlackRock are looking to make investments for the long term, those businesses that aren't alive to this activity or this requirement, or the rationale for it, I think will, over the very long term, start to suffer and find less access to capital. Hope it answers your question.
Yeah, and I think something that came out from what you were saying is you have this unique opportunity, right? So when you were talking about transition risk, one of the problems a lot of ESG investors have is that they're investing in secondary markets. So for them to actually show impact is incredibly difficult, right? Because you're investing in a business that already may be quite green, right? And I think Paul's point that saying, I don't know if you saw the news yesterday and the day before about the carbon reduction plan for the whole country. And that was a fairly detailed plan for every sector, right? So you might be taking a business. So in this context, it's like a primary versus secondary market thing. And in our group, we talk a lot about this, right? In the secondary market, it's very difficult to show impact, right? Because that you're buying a security that already exists, right? And so there's no new capital being deployed. In this context, well, you can buy loans, but you can also originate loans. And when you're originating loans, and it's especially to these businesses that are, let's say, perhaps, in gray, they're polluting, but if that loan is tied potentially to metrics that makes it cleaner, consistent with the government's transition plans, then you can show impact. Yeah. So I think there's a follow-on question.
So the impact you was mentioning is something like divestment strategy from the bad corporation, because you like originate their loan or something like that. So you divest from them to show you like threaten them.
I think divestment's a different story, right? So I think, no, I think you misunderstand. So it's original loans. Let's say, so you're getting a new category of financial products called transition bonds and transition loans, right? So these are firms that maybe other investors would have divested from, okay? But those loans are being given on conditions that they change their practices, yeah?
Yeah, just a nuance there, if I could add. Yeah, very much agree with what Ivan's saying. There's one nuance in private credit, and private credit's, it's kind of in the name. I think a lot of companies who are public or who access the bond market, bonds being listed, there's a big differential between the public market and the private market. So in the private market, you've got to be really careful what information different people have. In fact, you can't do that because that's basically creates insider opportunity. So business, BlackRock's a great example. They've got a huge public market business, what they do in those markets you just mentioned. They've similarly got a huge, big Chinese wall between that and their private market activity. And I think private markets is quite interesting because what it does mean, and Ivan's just alluded to this, is that the diligence you can do as a lender, as a borrower, prospective borrower, is unrestricted. You're only restricted by what the company's prepared to tell you. And often if the company needs something, finance, you can have a much more interesting discussion with what you would need as a lender to satisfy you with your due diligence. And whether it's credit or it's ESG, it's the same analogy. So I do think that certain companies are constrained by what they say and what they can do in the public markets because the information flow is quite difficult for the reasons we discussed. Back in the private market, which is a smaller market, I think there are things that can be done there in the context of a private transaction that maybe provides a greater degree of reporting, a greater degree of transparency, which might help with that development, if that makes sense. Cool.
So just to give the people online an opportunity, they haven't typed in, but if anybody wants to raise their hand, I can see if there are any questions there. I don't see anybody putting up a hand. Anybody online want to jump in and ask a question? If not, I'll come back to our privileged students in the room. So anybody else in the room want to ask a question? No questions online? Oh, one more where? Oh, right, okay. It's these two, they're the troublemakers, I've told you. No, only kidding. Great that you're asking questions.
I'm just curious about the actual size of the private debt market if it gets established in New Zealand, and like the size of like the ESG regulations compared to regular private lending. Like, well, compared to like all the banks and everything at the moment.
I think there's two elements. How big could the private market be? And then the ESG side of it.
Yeah, thank you. So New Zealand business lending, that's our framework for where private credit really is focusing. And there might be people looking at doing things around mortgages and the like. Let's exclude that for the time being. The business lending market in the country is about 120 billion New Zealand dollars. If we exclude agriculture is about 70 billion on top. So let's just keep that out of the equation. 120 means I can do the maths in my mind that way. Broadly speaking, 20 to 25% of that market is triple B and below, broadly speaking. RBNZ category 3, 4, 5, and 6. So as a number, 20, 25 billion, there or thereabouts. Growing about 5%. Saw those charts before. So, in round numbers, growing about $1 billion a year. Those assets repay. They've got each loan has a contractual maturity and it repays 3, 4, 5 years in New Zealand context, typically more 3, 4 years, offshore 5, 6, 7 years. But there's a cadence to that refinance activity. If I told you that the total amount of private debt capital raised in New Zealand, ignoring some specific niches like property and real estate and the like, is pretty close to zero, gives an idea of the scale of the opportunity. Sounds like a big number, right? I mean, for me, 20 billion sounds huge. In the context of what happens offshore, it's very small. And so we've got this situation in the domestic market where we're actually too small for the big overseas players to come in. They might do, Trade Me might get bought by a private equity firm, as did happen. And the financing for that often gets provided by private capital, but from offshore. It's a deal a year, maybe it's 2 deals a year, maybe it's a deal every 2 years. So if that's too small a market for the offshores, it's a pretty big requirement for New Zealand funding. From our perspective, that's one of the attractive features of positioning a business. Within that ESG, I'm not sure I've got a good answer for you in terms of defining that. Like, I think progressively, you might argue that 70, 80, 90, 100% of that market will have to have an ESG story. You know, governance is clear, social is clear. I think the issue at the moment is how transparent that is. We hear a lot about green loans, and the big four banks have each got teams doing that. That's fine, nothing wrong with that. But I think that's the first stage to really evaluate specific projects. I think as corporates adapt those policies and practices more, that market just basically morphs to really envelope that total side. There'll be a very small part of the market that isn't ESG compliant that people will be able to play in, I think.
Okay, we need to stop there because there's clearly another lecturer about to come in here. So thank you. I just leave, if we could show our gratitude to Paul. I think it was really fascinating. If private capital group doesn't work out, we could have him here as a lecturer, I reckon. So thank you, Paul. There's some more questions on there, but we'll follow up after that. Thank you, everybody.